Carol had done everything right. She and Robert had saved carefully, planned their retirement together, and for years their money ran like clockwork. Then Robert died. In the quiet months that followed, Carol expected a lot of things to get harder. She did not expect one of them to be her taxes. The next spring, she sat down with the same folder of documents she'd used for decades, and the number at the bottom of the return was higher than when Robert was alive. Her income had gone down. Her tax bill had gone up. It felt like a mistake. It wasn't. Carol had walked into what financial planners quietly call the widow's tax trap, and it catches people precisely because it makes no intuitive sense. Lower income should mean lower taxes, but for a surviving spouse, the income often falls more slowly than the tax rules tighten around it. Today, let's walk through exactly how that happens, using Robert and Carol to keep it concrete, and most importantly, what couples can do while both are still alive to soften it. Because once one spouse is gone, almost every useful move is gone too. It starts with a corner of the tax code most people never think about: your filing status. While both spouses are alive, most couples file married filing jointly, the widest, most forgiving version of the tax system. When one spouse dies, that doesn't change overnight. In the year of death itself, the surviving spouse can usually still file jointly, as long as they haven't remarried. After that, there's a narrow bridge the IRS calls qualifying surviving spouse status. It keeps the joint brackets for up to 2 more years, but only if you have a dependent child living with you. For most older widows and widowers, there is no dependent child, and that means, starting the year after their spouse dies, they file as single. This is the hinge the whole trap turns on, not the funeral, not the grief. A quiet change of filing status, from joint to single, that arrives a year or two later when everyone has stopped paying attention. Now here's what most people assume. When my spouse dies, our income is cut in half, so our taxes will fall too. Let's test that with Robert and Carol. Picture their retirement income. And these numbers are illustrative, just round figures to show the shape of the problem. Robert collected about $36,000 a year from Social Security. Carol collected about $22,000. On top of that, their traditional retirement accounts required withdrawals, around $30,000 a year, plus roughly $8,000 from interest and dividends. When Robert dies, Carol keeps just one Social Security check, the larger one. His $36,000 continues, her $22,000 stops. That's a real loss. But look at everything that doesn't stop. Those required withdrawals from the retirement accounts, they continue, and Carol still has to take them every year. The interest and dividends, they keep coming. So Carol's household income doesn't fall by half. It falls by roughly a quarter. She's lost a Social Security check, but she's kept most of the taxable income, and now she's facing all of it alone as a single filer. The grief is one loss. The tax bill, a year later, is a second one she never saw coming. This is where the trap springs. Two things change at the same moment, and both work against her. First, the standard deduction, the slice of income the government simply doesn't tax. For a married couple in 2026, that's about $32,000, plus a little extra because they're over 65. File as a single person, and it roughly halves. Overnight, more of Carol's income is exposed to tax, not because she earned a dollar more, but because she lost the larger deduction. Second, and this is the heart of it, the tax brackets themselves get narrower. Here's the part that genuinely surprises people. A single filer's brackets aren't just a little tighter than a couple's. Through the middle of the income range, they're almost exactly half as wide. In 2026, a married couple stays in the 12% bracket until about $100,000 of taxable income. A single filer crosses into the 22% bracket at just over $50,000. So watch what happens to Carol. Her taxable income barely moved, but as a couple, the top of it was taxed at 12%. As a single filer, that very same income reaches the 22% bracket. Same dollars, higher bracket. The income didn't move. The tax system compressed around it. That's not a penalty anyone voted for. It's just what happens when two brackets collapse into one. And for some survivors, it doesn't stop there. Several effects can pile on top of one another. Take Social Security itself. How much of your benefit gets taxed depends on your income, and the income thresholds where that tax kicks in are lower for a single filer. Here's the cruel detail. Those thresholds were written into law decades ago. They've never been adjusted for inflation, and the married thresholds were never set to twice the single ones. So a survivor can end up with more of her Social Security taxed on less total income. Then there's Medicare. Higher income retirees pay a surcharge called IRMAA, the income-related monthly adjustment amount, added on top of their Part B and Part D premiums. It's based on your income from 2 years earlier, and the thresholds for a single filer are about half those for a couple. Not every survivor hits these. A more modest household may stay below them. But here's the pattern. The higher your retirement income, the more these tend to fire at once. And because each effect keys off the same income, one large withdrawal can trip several of them in a single year. The trap gets deeper the more you've saved. So what can you actually do? The most important thing to understand is this. The best time to plan for the widow's tax trap is while both spouses are still alive, because almost every useful lever disappears once one of you is gone. Here are the ideas worth raising with a tax professional. None of this is individual advice. It's what to put on the table. First, think about Roth conversions during your married years, while those wide joint brackets are still open. Moving money from a traditional account into a Roth means paying the tax now at today's lower joint rates, so the survivor isn't forced to pull it out later at single rates. Second, look at whose name holds which accounts and how large the traditional balances are, because those required withdrawals are exactly what keep a survivor's taxable income high. Third, build some tax diversification. A mix of traditional, Roth, and regular savings gives the survivor room to manage their income year by year. And finally, know that relief exists for that Medicare surcharge. The death of a spouse is officially a life-changing event. You can file a form, called SSA 44, to have the surcharge recalculated on your new, lower income instead of a tax return from 2 years ago. Here's the thing to remember. The widow's tax trap isn't caused by any single rule. No one is being punished. It happens because of timing. Household income falls slowly, while the tax system narrows quickly, and the gap between those two lines becomes a tax bill that nobody saw coming. Carol couldn't fix it after Robert was gone, but the two of them sitting at the kitchen table years earlier absolutely could have. So if you're part of a married couple, do one thing this month. Ask what your finances would look like if just one of you were filing next year. Run the survivor's return before you ever need it, because the worst time to discover this trap is the year you're already grieving.